Number 12. Pay via EFT for the delivery of the goods at the business, 900 Rand. First of all, you must know delivery forms part of inventory. So your two ledger accounts involved will be inventory and bank. Both of these accounts are classified as assets. You are taking money out of your bank account. Your bank will have a negative effect of 900 Rand. To purchase inventory, so inventory will increase with 900 Rand. So let's go put this onto our answer sheet. So number 12, you're making a payment, so the journal involved is cash payments journal. It was an electronic funds transfer, EFT. The account debited was inventory. The account credited was bank. Because they are both assets, it will be plus minus 900 Rand in your assets. Number 13. Pay the first installment on the loan from Nedbank, 5,300 Rand. The amount includes the interest on the loan for the first 3 months. Since the total amount of 5,300 Rand is the loan amount plus the interest on the loan, we first need to calculate what the interest on the loan is so that we can know how much of the loan we are paying back. Because the total of 5,300 Rand is the loan plus interest. So we'll have to refer back to transaction number 10 to get all the details of the Nedbank loan. If you go back to number 10, the loan was 80,000 Rand and it was at an interest rate of 9%. So in order to calculate the interest on loan, we're going to take our loan amount of 80,000 Rand, we're going to times it by the rate of 9% for 3 over 12 months, and that gives us an answer of 1,800 Rand. So the interest on loan is 1,800 Rand that we need to pay. So now we can see what the loan amount repaid is. So if the amount given is 5,300 Rand, and we know that the interest on loan is 1,800 Rand, the difference of those two will be the loan amount repaid, which is 3,500 Rand. Now that we've got the two amounts, we can now actually record this transaction into the general ledger onto our worksheet. So the two ledger accounts involved for the first transaction, which is the loan amount repaid, will be our loan Nedbank account and it will be our bank account. We know that a loan account is classified as a liability and the bank is classified as an asset. Since we are taking money out of our bank account to pay for the loan, our bank will decrease and our liability will also decrease because we are setting a part of our loan, so our loan is going down. And the amount is 3,500 Rand. So let's quickly put this above transaction onto our worksheet. So since we are making a payment, the journal will be cash payments journal. It is directly from our bank statement. So our source document is bank statement. The account debited is loan Nedbank. The account credited is our bank account. R3,500 Rand in the debit side of liability. And 3,500 Rand on the credit side of assets. Now let's do the second part of this transaction. The second part of the transaction was the interest on loan. So our two accounts will be interest on loan and bank. Interest on loan is the owner's equity. Bank is classified as an asset. We are making a payment, so our bank balance will decrease. Interest on loan is an owner's equity expense, so our expense will have a negative effect on our owner's equity. So let's put this transaction onto our worksheet. The account debited is interest on loan. The account credited is bank. Owner's equity has a negative effect of 1,800 Rand. And our bank has a negative effect of 1,800 Rand. 14. The bank statement reflects a debit of 1,300 Rand with the reference being interest. So if the bank statement has a debit interest, then we know it is interest on overdraft. So our two ledger accounts will be interest on overdraft and bank. Interest on overdraft is the owner's equity, bank is an asset. Interest on overdraft is a payment, so it has a negative effect on our owner's equity, and since we are paying more money, our bank account is going down, so it also has a negative effect on assets. So let's record this onto our answer sheet. The journal involved is CCJ because you are making a payment. It is directly from our bank statement. The account debited was interest on overdraft. The account credited is bank. Owner's equity will decrease by 1,300 Rand. And my bank account will decrease by 1,300 Rand. Number 15. A credit note was issued to a debtor for goods returned, 1,620 Rand. First of all, when you return goods and you are dealing with inventory, you have to calculate the cost price. Now remember the formula for cost price again. You take your selling price, you times it by 100, and you divide it by 100 plus your markup. If you go back to number 2, remember our markup was 35%. So in this case, you're going to say 1,620 Rand, which is your selling price, times 100, divided by 135, gives you a cost price of 1,200 Rand. So let's determine the ledger accounts. Again, it will involve two transactions. The first transaction will be recording the credit note that the debtor is returning stock. So it will be debtors allowances and debtors control. And in the second transaction, we'll be recording the cost price, which will be inventory and cost of sales. Record the selling price. You are going to take debtors allowances and debtors control into account. Debtors allowances is an account that you open when a debtor returned stock that he is not satisfied with. Debtors allowances will be an owner's equity account, and debtors control is an asset account. Your asset, which is your debtors control, will decrease because he is returning the stock, so he no longer owes that debt, and your debtors allowances will have a negative effect on owner's equity. So let's go and record this into our answer sheet. So the journal involved is your debtors allowances journal. Duplicate credit note is the source document. The account debited is debtors allowances. The account credited is debtors control. You will take the selling price of 1,620 in the debit column of equity, and then 1,620 in the credit column of assets. Now let's record the second part of this transaction, which is the cost price. We calculated the cost price as being 1,200 Rand. Your two accounts involved when it comes to your cost price is inventory and cost of sales. Inventory is an asset. Cost of sales is an owner's equity. Your asset is going up in value. and your cost of sales has a positive effect. Now we are going to record the selling price of 1,200 Rand. So the account to be debited is inventory. The account to be credited is cost of sales. 1,200 Rand will be credited in the equity column, and 1,200 Rand will be debited in the asset column. Number 16. A debit note was issued to a creditor for goods returned 2,100 Rand. The two ledger accounts involved will be creditors control and inventory. Let's classify both of these accounts. Creditors control is a liability, inventory is an asset. Since the creditor is returning stock, his liability will decrease and inventory will decrease. So let's quickly record this onto our worksheet. So for number 16, our subsidiary journal will be our creditors allowances journal. Our source document will be our duplicate debit note. The account debited was creditors control. The account credited is inventory. Our liability is debited with 2,100 Rand, and our assets is credited with 2,100 Rand. Number 17. The account of a debtor who owes an amount of 450 Rand must be written off. Let's determine the two ledger accounts. Any amount written off for a debtor is known as bad debts, and our other account will be debtors control. Let's classify both of them. Bad debt is an owner's equity, debtors control is an asset. Bad debts will have a negative effect on owner's equity, and debtors control will also be reduced since the debt is being written off. The debtor no longer owes us this debt, so his balance will reduce. So let's quickly enter this onto our worksheet. The journal involved will be the general journal. The source document is a journal voucher. The account to be debited was bad debts. The account to be credited is debtors control. Your equity was debited with 450 Rand, and your asset was credited with 450 Rand. Number 18. The owner took inventory to the value of 3,510 Rand for personal use. First of all, when the owner takes something for personal use, we call this drawings. So our two ledger accounts will be drawings and inventory. Let's classify both accounts. Drawings we know is an owner's equity, inventory is an asset. Drawings will have a negative effect on owner's equity, and inventory will also have a negative effect on assets because we are taking stock for personal use, so our inventory levels will decrease. Let's enter our transaction onto our worksheet. So our subsidiary journal is our general journal. Our source document is our journal voucher. The account debited was drawings. The account credited was inventory. Equity will be debited with 3,510 Rand, and assets will be credited with 3,510 Rand. Number 19. The account of a debtor owing 3,000 Rand must be charged with interest of 12% for 6 months. Let's first determine the two ledger accounts involved. Because it is a debtor owing us, it will definitely be debtors control, and we are charging him interest since he has not paid his account. We call that interest on overdue debtors. Let's classify both accounts. Debtors control is an asset. Interest on overdue debtors is an owner's equity. since the debtor now owes us more money, we are charging him interest, and that is then a positive effect on owner's equity. And his debt will increase because he now owes us this interest, so debtor's control will be debited. This will involve a calculation. Our formula to calculate interest, you're going to take the debt amount, you're going to times it by the interest rate, and the number of months that is overdue. In this instance, he owes us 3,000 Rand at a rate of 12%, and we are charging him interest for the last 6 months, so 6 over 12. You will then get an answer of 180 Rand. So let's record this onto our worksheet. The journal involved is your general journal. The source document is your journal voucher. The account debited was debtor's control. The account credited was interest on overdue debtors. Owner's equity will be credited with 180 Rand, and assets will be debited with 180 Rand. Stationery to the value of 800 Rand, which was returned to a creditor, was accidentally posted to the account for fuel in the general ledger. Correct the error. So the two accounts involved is fuel and stationery. Both of these accounts are classified as owner's equity. Fuel will be debited to correct the error, and stationery will be credited. So let's put this into our worksheet. The journal involved is our general journal. The source document is our journal voucher. Account debited was fuel. Account credited was stationery. 800 in the debit side of equity, as well as 800 on the credit side of equity. Now this error has been corrected. Number 21. Receive an amount of 1,100 Rand from a debtor whose account was previously written off as irrecoverable. First of all, you need to know that when a debtor's account was previously written off as irrecoverable, we call this bad debts recovered. So the two ledger accounts involved in this transaction will be bank and bad debts recovered. Bank is classified as an asset. Bad debts recovered is classified as an owner's equity. You are receiving money, so your bank account will go up. And bad debts recovered is an income, so it has a positive effect on owner's equity. Let's quickly put this onto our answer sheet. The journal involved, because we're receiving money, is cash receipts journal. It's directly from our bank statement. The account debited was bank. The account credited was bad debts recovered. Equity will be credited with 1,100 Rand. And assets will be debited with 1,100 Rand.